My audio's not on. Oops. Okay, so I assume you can hear me. Can't use the earpiece because I didn't have it on. Okay, so online, if you have any trouble with audio, let me know because I messed up a little bit, but it'll be okay. So today we are going to finish up Chapter 2. I will tell you that Chapter 2 is going to be one of the meatiest chapters we have. It's going to take you more time than any other chapter. So here, let's do an experiment. Let Amir know if you can't hear me because I think my earpiece just kicked in. So anyway, so this chapter is one of the meatiest chapters. Spend the time on it. It will benefit you down the road. So today we have a question up first, and which of the following is an asset account? Last time I looked, I had 100% people right. Oh, we're close. So that list that we talked about on Monday, if you don't know what I'm talking about, download the PowerPoints. We had a list of assets, liabilities, equity accounts. You do have to memorize that. That is something that's going to be fundamental. It's like basic anatomy if you're a doctor. These are things you need to know. These are assets, these are liabilities, these are equity. So which of the following is an asset account? Just running through our choices here. Retained earnings is an equity account. Accrued liabilities, as you would think, would be a liability. Accounts receivable is the asset there. Accounts payable below there is a liability. Okay, so our answer here is accounts receivables, the asset. I'll leave this question open for a few minutes. It'll close at some undetermined time shortly. Okay, just a reminder, Meet Your Major is today from 4 to 5 p.m. in room 100, and if you're physically here in the College of Business, it's the room immediately below us. There is free pizza and a t-shirt. It's only an hour. I think it would be a great thing to go to. Chapter 2 homework is due this weekend. Again, don't try to rush through it. You really need this stuff. There'll also be, I cannot cover the entire chapter here today, so I will be sending out videos for the homework problems that I don't cover in class because I can't do them all. So those will be available to help you with the homework as well. Okay, so back to Chapter 2. And some of this is just a review of what we did on Monday. This slide is not in the PowerPoints that are on Blackboard. When I was getting ready for class today, I thought, what's one thing I really need to emphasize? And this is something that continually, it's so easy to mess this up because they're one word different. Whenever you see the words on account, those magic words, those words that say on account, that means automatically that it's either accounts payable or accounts receivable. And which one's which? Accounts receivable is the asset, and it's related to customers. So we sell customers something, and they say, we'll pay you later. So they owe us money. That's accounts receivable. That's an asset. The liability is accounts payable, and that is related to our suppliers or our vendors. We go buy something, and we say, we'll pay you in 30 days, send us an invoice, something like that. That's accounts payable. So whenever you see the words on account, and we're going to see those some today, you're going to see them in the homework. Whenever you see on account, right then and there, you know it's either accounts receivable or accounts payable. Accounts receivable is the asset related to customer dealings. Accounts payable is the liability relating to suppliers. So that was just something I wanted to emphasize. So, for example, when we perform services on account, so if I were to say perform services on account means automatically it's going to be either accounts receivable or accounts payable. If we perform services, that's for our customers. So in that case, we perform services on account would be related to accounts receivable. If we bought merchandise on account, so we went and bought paper on account, that would be accounts payable because it's our supplier. Okay, so that was just a little clarity on accounts payable, accounts receivable. Then one more thing I wanted to follow up on, where accounts go. We talked about these assets, liabilities, and the two major categories of equity, which are common stock and retained earnings. Those items go on the balance sheet. So when we talk about balance sheet accounts, we're looking for assets, for liabilities, and those equity accounts like common stock and retained earnings. The income statement. The income statement is all the revenue and expense accounts. Now remember, net income is revenues minus expenses. We will see gains and losses also on the income statement. So when we say, what's on a balance sheet, if we say, here's a list of accounts, what goes on a balance sheet, you should pick out all the assets, the liabilities, and the equity accounts. And the equity accounts that we're talking about at this point are common stock and retained earnings. When we talk about what's on an income statement, well, what's on an income statement is our revenues, expenses, and then we have gains and losses that we haven't talked a lot about yet, but they're on there too. So when we talk about which statement an account goes on, this is a basic, these are fundamental things to know. Balance sheet accounts are assets, liabilities, and equity. Balance sheet is the accounting equation, okay? Now, income statement, revenues, expenses, gains, and losses. So we're going to do a question, another question. Are you starting it? Okay, so when services are performed on account, what happens? Cash is increased, revenue will not be recorded until cash is received, accounts receivables increased, accounts payables increased. Okay, so let's see if we can talk through this, because there's a way we can get to the answer without knowing exactly what we're doing, okay? When services are performed on account, right then I think about what's happening there. What are the two things going on there? Well, services performed means service revenue. We are earning service revenue. So that's one side of this. Notice I don't even need to know what side. Service revenue is one side. The other side of this, those magic words on account, mean it has to be accounts receivable or accounts payable, right? So so we know we have service revenue and then we have accounts something. So that we should be able to get that far. Services performed on account, we have service revenue and accounts something. So looking at the first one, cash is increased. Is cash any one of those two accounts? No. So it cannot be A. We don't need to do any more analysis of A. B, revenue will not be recorded until cash is received. Cash is not part of that conversation at all. So we can eliminate B. Okay, so now we're down to C or D, accounts receivable or accounts payable is increased. We don't even need to worry about if it's increased or decreased. All we need to be able to do is say, is this accounts receivable or accounts payable? Service revenue performed on account. So service revenue, is that service revenue generated by from our customers or from our suppliers? It has to be our customers, right? So let's see where we are here. Okay, so we said it can't. Okay, so we're climbing a little bit. So as we go through this, we've said it can't be A or B. When we go back to just 2 slides ago, let's go back here. Okay, on account. Accounts receivable is related to customers. Accounts payable is related to suppliers. So what we see here, so we're picking between C and D. When we perform services, that's for customers. Okay, so customers are related to what we're going to pick here. Okay, I'm going to be closing this in 10 seconds. Okay, accounts receivables increased. So on these questions, you don't have to necessarily get very down deep. You can eliminate certain answer choices right away. Like we were able to eliminate A and B right away, and then go down to do we pick C or D. We're dealing with customers, and customers relate to accounts receivable. Okay, let's do one more before we get into the rest of the material. And this one, before I send it out there, choose all of the accounts that we listed on the income statement. On this one, you're going to pick more than one answer. You are actually going to pick 4 choices. And once you pick 4 choices, I believe you have to submit or save, something like that. Yes, there are 4 choices. And again, when you put your 4 choices in, after you're done, hit submit or save. Okay, so this relates to that slide about what accounts are on the income statement. Okay, we're going to close this in about 10 seconds, so you want to make sure. It looks to me, from what I can see, is some people have not hit the submit button. Make your choices. Make sure your answer has been accepted by saying your answer has been hidden, or show your answer. Once again, this answer is in your notes from just 2 slides ago. Pardon me? Yeah. Okay. So again, the income statement, we're going to see revenues, expenses, gains, and losses. That's the income statement. Okay. So now, last question before we go is choose all the accounts that would be on the balance sheet. Remember, the balance sheet is the accounting equation, and in this case, you would basically, if you know the accounting equation, you can answer this question. Okay, and it's there again. Again, this is when you have to press submit after you've chosen your answers. Okay, so the accounting equation, think about what the accounting equation is. It should be in your notes. Those are the accounts that are on the balance sheet. I'm going to close this in about 10 seconds. Okay, assets, liabilities, stockholders' equity. The accounting equation, assets equal liabilities plus equity, is fundamental. You need to know the accounting equation. And so lots of you do that, know that, so that was good. And the balance sheet is the accounting equation represented in numbers. So moving on from here, we're going to do a homework problem, short exercise 2-3. In short exercise 2-3, we have a doctor that opened a medical practice, and then we have a series of transactions. Now, this exercise is not asking us to record the transactions. It says, after these transactions, how much cash does the business have to work with? Okay, so it's asking us cash. That's all it's asking. It is not asking for us to do the journal entries. It's not asking us for the increase and decrease. It's saying, what's the impact on cash? So we're going to look at every single item and say, is cash involved? So starting with the first one, Patel invested $60,000 cash to start her medical practice. The business issued common stock. So this is from the standpoint of the business. So the business, the first thing, does the business, is cash involved? Yes, the word cash is there. So the word cash, so we know 60,000 cash, and we want to say, is cash increasing or decreasing? And in this case, the business received 60,000 of cash. So we're going to see a cash 60,000. So all I'm doing is making a note of what's happening to cash after each transaction. So the first one, cash increases by 60,000 July 1st. There we go. So there's one transaction, one impact on cash. It does not ask for the whole transaction. So we are simply looking at each item and saying what's the impact on cash. Second one, purchased medical supplies on account. There is no cash involved in that. We purchased medical supplies on account, which means we went and got the medical supplies and they're on account, which means it'll be accounts payable because it's a supplier. Now, we will pay for them down the road, and when we pay for them down the road, cash will be involved. But on July 1st, there is no cash involved in that transaction. So again, we're taking each transaction by itself. Okay, we record transactions. Later on down the road, when we pay for them, we will record that transaction. Okay, so July 2nd, paid monthly office rent of $4,700. The word paid implies cash. So when you see paid, unless told otherwise, paid means cash. So we paid monthly office rent of $4,700. If we pay out cash, cash is decreasing. So we're going to see cash decreasing by $4,700, so minus $4,700. So far, we have cash increasing by $60,000, cash decreasing by $4,700. Okay, and then we get to July 3rd. July 3rd, we recorded $10,300 revenue for service rendered. Okay, so she did medical services for $10,300, received cash of $4,200, and sent bills to patients for the remainder. So again, we're looking for cash only. We look at this. We received cash of $4,200, so cash is increasing by $4,200. So we had 4 transactions, only 3 of them impacted cash. We had the $60,000 they received July 1st, we had the $4,700 they spent July 2nd, and July 3rd we received $4,200 of cash as well. Now the last little bit of this transaction says, the last instructions of this exercise says, after these transactions, how much cash does the business have to work with? It says, use a T account to show your answer. So this is where we're segueing in to talking about T accounts and debits and credits. So for the last part of this, we need to use a T account. I'm going to give you a brief overview for this exercise, and then immediately we're going into the whole talk about T accounts. So here is a T account down below. Okay, a T account looks like a T. It'll have the account name on the top. So we have cash. And that T account on the left, because this is cash, and this is one of those things, trust me on this, we'll talk about why. So beginning balance for cash goes on the left. That $4,700 decrease goes on the right. The $4,200 increase goes on the left, and our balance goes on the left. Let me let you write that down, and then I'm going to talk through what we just did. And again, we're going to have this coming up in just a minute. We're going to talk much more about T accounts and why we put things on the left and right. A T account is a way for us to keep track of activity in an account. So a T account has a left side and a right side. And trust me for about 5 minutes on this. Cash, when we have cash, increases go on the left, decreases go on the right. So when we have to do this homework problem, cash is the name at the top of the T account, looks like a T. We will put, the first thing we do is we put our beginning balance on the left. For cash, beginning balance goes on the left. And then any decreases will go on the right-hand side. In this case, we have one decrease. We don't put a negative sign because by putting the 4,700 on the right side, that's a signal that this is a decrease. And then we'll put that increase on the left side. And then what we do when we've got all our transactions done, so we have the beginning balance, we have the increase, both of those on the left side, the decrease on the right side, then we draw a single underline. So that underline that's going across the bottom, that's to say, let's drop a total in. And that total, how we get the 59,500 is we add everything on the left and subtract everything on the right. So we have the account balance, and the account balance goes on whichever side is greater. So the 60,000 plus the 4,200 is 64,200. That's greater than 4,700, so we subtract the 4,700, and we put the balance on the left side. Notice there are no negatives in a T account. There will never be a negative in a T account. Okay, but for this exercise, what it's asking you is how much cash is left at the end of the period. And the answer is 59,500. And they simply asked you to put it in T account form. Okay, and we're going to get to T accounts in just a moment. But that's what you do for this homework problem. Look through each of the transactions, figure out the impact on cash, then do this little T account at the bottom, at the end of it, where you put your increases in cash on the left, the decreases on the right, and then draw a single underline. The difference between your left numbers and your right numbers goes down below the underline on whichever side is larger. Okay, another one to practice. A company paid cash for an amount owed to a creditor. This transaction decreased cash and did what else? Okay. So, okay, let me talk through what happened here. Okay, so we paid cash for an amount owed to a creditor. Another way we could do that is we could pay cash on account, which is saying we're paying off something we owe. So what's going to happen, we're going to give up cash, and when we give up that cash, we're reducing our debt to that creditor. We're reducing the amount we owe that creditor. And when we reduce an amount we owe, that's the definition of a liability, right? So when we pay cash to reduce what we owe, we're decreasing cash and we're decreasing a liability, right? So we're actually going to be decreasing accounts payable here. So what happens is we decrease our liability, we actually, and I'm just telling you, it's accounts payable is what's going on here. So we decrease cash, we decrease the amount we owe. I'm going to close that in 10 seconds. Yeah. Okay, the question is, since we decrease cash, when we have to increase something to balance it out. We're actually balancing it out because if you think about the accounting equation, we have assets equal to liabilities plus equity. So we're having a reduction in assets and we're also reducing liabilities. So we have like a minus 100 on the left side and a minus 100 on the right side, which means it's balanced out. Because what we're trying to balance is assets equal liabilities and equity, those two sides. So we could We could decrease an asset and increase an asset, and that'll balance. But if it's on two different sides, we're going to have to decrease both of them. Okay? Good question. Okay, good. 100% on that one. Woohoo! Okay, next up, transactions on account. So this is where we're getting into debits and credits now. So this is where it feels uncomfortable, and I know that there's no two ways about it. If you've had bookkeeping and accounting in high school, that's going to help you some here. But these are, you're just going to have to plod through it, and the more you do it, the more comfortable it gets. It's kind of like a foreign language. Okay, so the system of debits and credits is a double entry system. We already said that every transaction has two sides. We have something we're giving up and something we're getting, kind of roughly, and every transaction impacts at least two accounts. Okay, so we're moving further into this idea of debits and credits. Okay, a T account. So we have a T account, and a T account is a record of increases and decreases in a specific asset liability, a specific account. Now, when we talk about T accounts, always, 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 there is no exception. Debits will always be on the left, credits will be on the right. That doesn't change. This line right here, this title line where we have debits and credits, you don't see that on a T account normally. We're just putting it here for illustration. Normally a T account just looks like a T, and everything on the left is a debit and everything on the right is a credit. Doesn't matter what type of account it is, that's the way it always will be. If we were looking at our accounts in the general ledger, the actual accounts for a business and how they keep track of them, debits are always on the left, credits are on the right. So a T account is a way we have to work with this abstract concept of an account. So that's a T account, debits on the left, credits on the right, always. So this is another thing you need to memorize. A T account, debits on the left, credits on the right. So when we look at this, again, the account title, the left side's debit, the right side's credit. We normally don't have the titles that say debit and credit at the top. Okay, yesterday I emailed out a sheet to you, a debit credit sheet, and that's what we're going to be looking at now. And if you're online, this was the file that was offered to you. If you are viewing this later, you can type in the URL http://tiny.cc/debit-credit. If you're online, you cannot click on the screen. That is not a live hyperlink. We don't have the capability to do that, but you can download this. This is actually a, do you have the cursor in the middle of the screen? Is that yours? Not mine. There, it's one of them. Okay, got it. Okay. This sheet is kind of my mental representation of what I go through when I decide what's debited and credited. An abbreviated version of this is on the exam info sheet. So I want to show you what's on this sheet to begin with. So this is the debit credit rules. We're going to go through those in a minute. But down under step 3, I've given you some examples of assets, liabilities, etc., because you have to decide what kind of account it is. Those examples do not are not going to show up on the exam info sheet, but the exam info sheet does have the general overall steps and the rules, and that table in step 4 is on the exam info sheet. At any time, if you want to look to see what's on the exam info sheet, what you'll be able to use on the exam, that is on Blackboard under exam info. But so a lot of the sheet is on there, not everything on the sheet. But these are rules, and I'll be referring to step 1, step 2. Can you give me one? Okay, so this sheet, when I'm talking through journal entries today and in the future, I'll be referring to step 1, step 2. When we're doing entries, we're going to use this sheet, and this sheet, so that's there for you. I'm going to flip to the next page. We have debit credit rules. These debit credit rules are huge, but you do not need to memorize them because this step 4 down here on the sheet is on your exam info sheet. So this debit credit rules, absolutely, I would have it in class every day. Every day have it because I assume you have it. The easiest question I can ask you in class is something like, what increases in asset? Well, you would look and you'd say debits. So assets, expenses, and dividends are increased by debits. Debits decrease liabilities, common stock, retained earnings, and revenues. These are the rules. In a few minutes, I'm going to talk about your bank account. So if you're thinking about your bank statement, thinking this doesn't make sense, we'll get there, but I want to wait a little bit to talk about your bank statement, why it's the way it is. But these rules, knowing what increases an account and knowing what decreases an account, these are the bedrock of everything we do with respect to journal entries and knowing what we debit and what we credit. Very easy. You don't have to memorize these rules. I am not saying memorize these rules. If you're an accounting major, yes, you memorize these rules. You're going to need them in corp accounting, which is the next financial accounting class you take, typically the first one you take as a junior. You will need these rules. You will need to know them inherently. But everyone else, you don't need to memorize them. They're on this sheet. I'm telling you now, they're on that debit credit handout. They'll be on the exam info sheet. And I also expect you to have them here in class. They are those things. Those are just fundamental rules for this class that you need. So we're taking those at face value for now, and we'll go to there. So let's do a journal entry using those steps. Okay, so if Ford Company buys a new machine for $8,000 cash, what is the journal entry? Okay, so the first thing I'm going to do is on my sheet, the first step says pick one account that's impacted by this transaction. So Ford Company buys a new machine. So I'm going to go with that, machine. Let's call that equipment. Okay, machine or equipment, you would recognize an account off a drop-down that said equipment or machine. So that's the account that I'm picking. I'm picking equipment. Step 2, is this account you picked in step 1 increasing or decreasing? Well, we're buying equipment, we're buying machines, and when we buy it, we're getting it, so it's increasing it. So now I've answered step 1 and step 2. So I've got equipment increasing. Step 3 says, what kind of account is this? What type of account is this? So I look through my list, equipment, I may just know it, but I look through, if it's early stage, equipment is an asset. So again, when I told you you need to know what kind of accounts are, this is why. You won't be given this list of examples of assets, you just need to know. So equipment is an asset, okay? So far, step 1 is equipment, step 2 is equipment, step 3 is asset, and it's increasing. Okay, so we're increasing an asset. So now go to step 4. We have an asset increasing. So an asset increasing, that table, I've got assets. Okay, so down here at the bottom, table, I've got asset. I know it's an asset. And I'm increasing an asset, equipment. So I'm going to debit it. So what I'm going to see here is I'm going to have a debit to equipment. Now, this is a journal entry form. In the old days, We wrote out journal entries on paper. Nowadays, they're done electronically, but we have a record some way. So since we're dealing in class, it's hard to visualize electronics. So we'll just use the old standard like paper, but this is the same thing that happens in the computer. A journal entry has a date column. We always have a date for a journal entry because we have to cross-reference it to documentation. Fundamental financial accounting principle is that our information can be audited and verified. So we need to be able to trace it back to say, here's proof that we did this. So we'll have the date. That's a fundamental thing. So we have a date, and then we have the account. So here's the account name, equipment. And then there's two columns in a journal entry, debit column and a credit column. The debit one is always the one on the left. So we have equipment for $8,000. Okay, so there are at least two accounts for every transaction. So, and this is the other rule, in every journal entry, my debits have to equal my credits. That's where we're back to, this has to balance the accounting equation. It's all related. So my debits have to equal my credits. So here's a shortcut now. So we've got our equipment. We know equipment's increasing, right? We've done that. We walked through our steps. Right now, before we go any further, before you go any further, you could write $8,000 in the credit column and you'd almost be done with this journal entry. Because debits have to equal the credits. Once you have the debits, you know what the credits equal, then you just have to figure out what account it is. So I'll get to that. So if we go back to our sheet for the second part of this analysis then, so we finished steps 1 through 4, okay? And now it says repeat for the other account in this transaction. So going back to step 1, pick the other account that's impacted by this transaction. So we bought equipment. What else is going on in this transaction? How do we buy it? We bought it with cash. So cash is the other side. So we have cash, and then it says, is this account increasing or decreasing? Cash is decreasing, okay? So cash will decrease. What type of account is cash? Assets. So that's step 3. So step 4, we have an asset that's decreasing, and it tells us to credit it. So now I'm going to put in cash. Now, notice that this cash here is indented. That is indented 5 spaces or so. We have to indent credits. When you're doing your homework, your credits have to be indented. Credits have to be indented. Credits also need to be out in the credit column. Okay, another couple rules about journal entries. So our debits have to equal our credits. Debits always have to go first in the journal entry. Always. So we're always going to put the debits first. That isn't to say we couldn't, in this one, we could have done the cash line first, but once we discovered it was a credit, we would have to put it on a lower line. So your debits are always first, your credits are always second. Your debits have to equal your credits. You have to indent the name of the credit account. These are all conventions. They all absolutely have to be followed. Okay. We have consistency in accounting, so things are easier to interpret, standard ways of doing things. Okay, so this is the journal entry for buying equipment with cash. We also have one more piece left. Can you move that? Somebody's clear. Oh, it's fine. Okay, we have a memo line. A memo line is required in a lot of the journal entries we do in the homework. It might say include a memo line, or it looks like you need to include it. For the most part, we need a memo line. A memo line tells us what this is. And in real life, we use memo lines because, believe me, 6 months down the road, you're not going to remember what this entry was for. So people just write a short description of what that is. So that's our first journal entry. So journal entries, we have debits first, credits second. Credits have to be, the name of the account has to be indented, and our debits have to equal our credits. And that debit credit handout will get us through most situations. And again, you have most of that debit credit handout on the exam info sheet for every exam. So the debit credit handout portion that you have on exam 1 will also be on exam 2 and exam 3. And again, you don't need to memorize the debit credit rules, but you have to have them with you. I will assume every single day in class that you have that debit credit handout or those rules right by you, because we're going to have questions that take advantage of those rules. Okay, so let's do another one. Seifert Company buys office supplies on account for $4,000. So again, walking our way through this process, the first question is pick one account that's affected by this transaction. So the first thing I see is office supplies. Okay, office supplies is an account. Is this account you picked in step one increasing or decreasing? Office supplies is increasing because we're buying office supplies, so it's increasing. What type of account is this? Supplies are assets, okay? So supplies are assets. And then the fourth step. So combine our answer from 2 and 3. We said it was increasing in asset. So we look on assets, increase, so we're going to debit office supplies, okay? Because we're increasing an asset. To increase an asset, we debit it. Okay, now the other side we're going to repeat for this one. So we purchased office supplies on account. Those are our magic words, on account. On account says to us immediately that this has to be either accounts payable or accounts receivable. Accounts receivable has to do with our customers. Looking at this, we're buying office supplies. That's not a customer transaction. So this has to be accounts payable. So accounts payable is the other side of this transaction. So pick one account that's affected by this transaction, accounts payable. Is this increasing or decreasing? We bought office supplies on account. That means we owe this company more, so it's increasing. Step 3, what type of account is this? Well, accounts payable is a liability. Typically, you see the word payable, it's a liability. So we have accounts payable increasing. So in step 4, we see liabilities. To increase a liability, you credit it. So what we're going to see here is we have a credit to accounts payable for $4,000. Notice that I have indented the word accounts payable because it is a credit. My debits equal my credits. Basically, on a journal entry, if you get the first line, the second line, you know the amount, and then you're left with what account is this. So once you do one side of the entry, the other one kind of pops into play. Now, I wanted to go back here to this one just briefly and talk about your bank account because this is a common misconception. So when we look at, or maybe even we'll go back a little further. When we look here, we say that debits increase assets and credits decrease assets. So this is cash. So let's think about cash. So I will tell you right now, cash is my easiest account to deal with. Cash increases with a debit, cash decreases with a credit because it's an asset. Those are our rules. But invariably someone will say, well, when I get my bank statement, the bank statement debits my account for ATM fees and it makes it go down. But I'm telling you that cash is an asset and it goes up with debits and down with credits. So it's exactly opposite of your own bank account. Let me tell you why. So let's think about it. When we're talking about cash in here, like in this case, the company has cash, it's an asset to the company. So it follows the asset rules. Asset rules say to increase an asset, we debit it. To decrease an asset, we credit it. So now let's put yourself in the position of a bank. So now I'm a bank, okay? Now a customer comes in and gives me $100 and opens up a checking account, okay? So now this customer has given me cash. I'm the bank. So given me cash, that's cool. I've now got cash, so cash increases. But what's the other side of that transaction for the bank? The bank now has a liability to you, right? Because you've given them $100, and now the bank owes you $100. And the bank is going to keep that money in your checking account for you. But for a bank, your checking account, your savings account is a liability, okay? They have cash of their own, that's fine. But when you have any deposits at the bank, any accounts at the bank, those are liabilities for the bank. The bank owes you the money. You walk up to the counter, they have to give you your money. So accounts, checking accounts and savings accounts for consumers, from a bank standpoint, are liabilities. So if we look at our liability rules, to increase a liability, you credit it. To decrease a liability, you debit it. So when you get your checking account statement from the bank is giving you an account list, an account transactions for a liability account because the bank has a liability to you for your checking account. That's a liability to them, an asset to you. So that's why everything sounds backwards on your bank statement when they say we debited your account and it reduces your balance. That's because it's a liability to them, and debits decrease liabilities, credits increase liabilities. So your bank account, remember, when you see your checking account statement, the bank is printing it out as though when they print your statement out, that is a liability for them, and that's how they debit and credit things. So that's all that's happening. That's what's happening there. Okay, so this should be pretty good. We've got, so we have our debit credit rules, and which of the following statements about the rules of debits and credits is correct? So you only have to find one. There is only one statement there that is correct. Okay, debit credit rules. I'm going to take pity on you today, but in the future, never again. Debit credit rules. You should have that file, that handout that I gave you, looking at that little chart, or the PowerPoints that we just went by. Let's go back to that. Let me show you here. Okay, debit credit rules. Debits increase assets, expenses, dividends. Credits increase the other, and then you can just flip it around for the bottom part, okay? So debits increase assets, expenses, and dividends. Just go with that thought. So debits increase assets, expenses, and dividends. So now going to our question, which of the following statements about the rules of debits and credits is correct? An asset is increased by a debit, right? Very first one we have, it has to be that one. And we don't even have to go any further. We can just ignore the rest because we found the right answer. Going to close that in 10 seconds. Okay, so now onward. So we'll, in your homework, I'll have some videos that practice that whole, with the homework you'll have journal entries to write. So I have some videos step by step on the homework practicing the debiting and credit for journal entries. Now we're going to talk about, okay, so the next step, we have transactions occur, we write journal entries. So what? What do we do with them? Well, those journal entries, we actually have to post them to the accounts. So we have something called a journal, and a journal is a record of all our transactions, and our transactions are journal entries. So the journal entries go into the general journal, into the journal. Okay, so it's a chronological record of transactions. So what we do with the journal entry, is right here is an example journal entry. So the journal entry we have is April 1st, we received cash, $50,000. I know we received it because cash is debited, and we credited common stock. So we issued stock is what we did here. We got cash, issued stock. So we increased cash, we increased equity account. So with the journal entry, what we do is we post the journal entries, or when we to the journal. Okay, now the journal has accounts in it. So the journal entries are in the journal. Once they're in the journal, then we have to post the journal entries to the accounts. We have 2 accounts here. We would have accounts for every single account, but to illustrate this, I've only got 2 because there's only 2 accounts in this entry. So the first thing I'm going to do is I'm going to go to the T account and I'm going to put my debits on the left. Okay, so I'm going to take my journal entry, the cash debit there, and put it on the debit side of the cash account. And then I'm going to take the common stock entry and put it on the credit side of the common stock account. Okay, now I'm going to do this. I'm going to potentially have thousands and thousands of journal entries, and every journal entry is going to be posted to the accounts. So every transaction to cash is going to go into cash. Every transaction into common stock is going to go into common stock. And at the end of the period, we're going to get our balance of all our accounts. And then that goes on to our next step. So to summarize what we've done so far, accounting data, we have something called the accounting cycle. So we start with the transaction occurring. So the transaction happens. Then we analyze the transaction, say, what's going on here? And then we enter the transactions into the journal, and this is where we're writing the journal entries. Okay, and then after the amounts are in the transactions are in the journal, then we're going to post the amounts to the accounts. And then at the end of the period, we're going to have all the balances of our accounts. Which brings us to the next learning objective. So we have all our accounts, we have all our journal entries posted, we have all the balances of our accounts after we've posted all these entries. And what we're going to do next is we're going to do something called a trial balance. And a trial balance lists all the accounts with their balances. So we've done the journal, we've done all the journal entries, we've posted all the accounts to we posted all the journal entries to the accounts. We have balances of all the accounts. Then we're going to take all those balances and put them in something called a trial balance. A trial balance lists all the accounts with their balances. The assets are listed first, then liabilities, then stockholders' equity. And the purpose of a trial balance is to show that our debits equal our credits. Okay, so a trial balance lists our accounts, assets, liabilities, equity, just in a row. It proves that our debits equal our credits. It is not a financial statement. Okay, our financial statements that we issue are the income statement, the balance sheet, statement of retained earnings, and statement of cash flows. The trial balance, its purpose is to show that our debits equal our credits. A trial balance is nothing we would publish on the outside. Okay. Now, accounts on a trial balance either go in the debit column or the credit column. Which column they go on depends on their normal balance. So that debit credit handout we had, whatever increases the account. So on the debit credit handout, let me go back there. Oh, this is going to be a while. Okay, so on our debit credit handout, okay. Okay, on our debit credit handout down here where it says step 4, type of account, whatever increases an account is known as its normal balance. And that's what column that total, its balance, goes on the trial balance. This is also, as long as you remember that what increases an account is its normal balance, that is on your exam info sheet again. So you don't have to have a separate thing that says here's the normal balance of each account. It's whatever increases that account is its normal balance. Okay. So whatever increases the account is the normal balance. It's also, they have a table in your book, Exhibit 214 of your book. What we're going to do now is I'm going to show you a trial balance. And this trial balance is actually short exercise 2-9. And what we're told is, here's a table of information. Let's prepare the trial balance and list the accounts in their proper order. So this is a great exercise because it's very short. We only have 7 accounts in total. So we're going to put together a trial balance. And what I'm going to do first is I'm just listing it there. And I'm going to go quiet for a minute or two, let you jot it down, and then I'll start talking once I see most people are done writing. Some things to note here. First of all, this is not a financial statement, but like financial statements, the top line is the name of the company. The second line is, what is this? It's going to say it's a trial balance. And then the date line on a trial balance is always one date. It's saying, here's the balances as of this date. So those are important to get all of those. So a trial balance is as of one date. It's saying, here's our balances right now. So the trial balance lists the accounts. These are not random order. The accounts go assets, liabilities, and equity accounts. The assets are listed starting with cash from most liquid, most like cash, down to long-term. Liabilities start with accounts payable, go to longer-term things, and then stockholders' equity, followed by revenues and expenses. So that is not a random order. They do go in this order. Now, which side things go on goes by what normally increases that account is its normal balance. You will never see a negative number on a trial balance. Whether they're in the debit column or the credit column tells us what their balance is. So the first line here, cash has a balance of $5 million. And again, we're not putting those 6 zeros in because it's up at the top. Okay, then other assets, those are both in the debit column because those are assets, and assets are increased by a debit. Accounts payable, other liabilities are both credits because liabilities are increased by credit, so they have a normal credit balance. Stockholders' equity has a normal credit balance, so it's over in the credit column. Revenues are increased with credits, so they're over in the credit column. And then expenses are increased with debits, so they're over in the debit column. So once we're done putting all our balances, we draw a single underline, and then we add everything in the column. So we add the 5, the 20, the 27, and we get 52. And then in the credit column, we add those 4 numbers, and we get 52. At the end, we can do a double underline. And what we are doing here is we are proving that our debits equal our credits. And this looks like we posted our accounts correctly. Your trial balance, your debits have to equal your credits. So our accounting equation is in balance. Now this question also asked one other thing. It asked, what is our net income? And our net income would be 11 million. How do I know that? It's my revenues minus my expenses. My revenues are 38, my expenses are 27. 38 minus 27 is our net income of 11. Something to take note of here. So you need to know that net income is revenues minus expenses. Another thing I would put over in the margin in big letters, dividends never impact net income. Dividends are considered a return of capital to owners. Dividends are never on the income statement. So if you go to calculate income, income is always revenues minus expenses. Okay, so income, revenues minus expenses, never dividends. Dividends are never on the income statement. Never, ever, ever, ever are dividends on the income statement. Okay, so we're going to do a couple questions here. So, in 2014, revenues for the year totaled $300, while expenses for the year totaled $100. Dividends declared and paid were $25. What was net income? And remember, don't use a dollar sign. Okay, just a refresher. Okay, net income is revenues minus expenses. We said our revenues are 300, our expenses are 200. So with this question, you're going to take, do you have a question up there? No? Okay. With this question, you're going to take revenues minus expenses. Remember that dividends never ever impact this. I'm going to close this in about 10 seconds. Revenues minus expenses. Somebody has a dollar sign in their answer, really quickly, put your answer back in without a dollar sign because it will be wrong. Thank you. Okay, so your answer is $200. It's simply 300 minus 100. Dividends never, ever, ever impact net income. Okay, that's a rule for the whole semester. Dividends are never part of net income. Okay, here's another one. A trial balance is one of a company's major four financial statements. A trial balance is one of the major four financial statements. True or false? That answer is false. I'm going to close this in 10 seconds, so correct your answer if you answered it incorrectly. Okay, a trial balance, its reason for being is to make sure that debits equal credits. That is its reason to exist. Trial balance, debits equal credits. That's why we have it. It is not one of the major financial statements. Okay. Okay, so the trial balance is used, it's not a major financial statement. What is its purpose? Okay, when a company makes the trial balance, its sole purpose is to make sure our debits equal our credits. We can't tell from looking at a trial balance if assets equal liabilities and equity. Notice that A cannot be right because assets will not equal total liabilities unless some weird circumstance exists. So C can't be right because revenues don't equal expenses unless your net income happens to be exactly zero. Total increases in accounts equal total decreases. That doesn't hold true either. The only answer there that can be correct is B, total debits equal total credits. Okay, let me do this one. When a company pays an amount it owes a creditor. Okay, so when a company pays an amount it owes a creditor, let me tell you the journal. So let's write this journal off to the side, and this will help you. When a company pays an amount it owes a creditor, what they're doing is they're debiting accounts payable and they're crediting cash. That's what's happening. So we will debit accounts payable and credit cash. So you have debit accounts payable, credit cash. So when you do that, let's think about what kind of account is accounts payable. Accounts payable is a liability. If we're paying off a liability, we are reducing it. So we are decreasing liabilities, and we're crediting cash, which reduces cash. So we are reducing cash, which is an asset. So we are reducing liabilities, and we are reducing assets. Okay? So there's only one answer there that can be right. Okay. Okay, and then one final question. When a business purchases land on account, okay, so let's think about this. When we purchase land on account, I will tell you the journal entry. I'm not going to tell you the answer on this one. So when we purchase land on account, we purchase land. That's an asset that increases, right? So assets are increasing. And then on account means that this will be accounts payable, a liability. So on account, it's a liability, and we're increasing the amount we owe as well. So we've got an asset increasing and a liability increasing. So get your answer in the next 10 seconds or so. Or not. Can I help you? Can I help you? Oh, you're here early? Yeah. Oh, okay. So you guys want this question? Have a seat. We're almost done. Just hang out. Okay. Maybe I should put the right one up, huh? Okay. Okay. So it's there now. Okay, when a business has purchased land on account, so again, we've got land and asset, and we've got accounts payable liability. Okay, I'm going to close this in 10 seconds. Okay, so we're getting land on account. Land is increasing. Okay. land is increasing, accounts payable, which is our liability, we're taking on more debt. Okay, and that assets and liabilities are both increased. We've got land going up, accounts payable going up, so the two of them increasing. Okay, Chapter 2. Chapter 2 is going to take you some time. Get started on it. I will email out lists for step-by-step videos on the homework problems we did not cover in depth, and I will see you Monday.